colleagues and friends of CFA Society Portugal for co-hosting this conference. And thanks to Javier López Bernardo, member of CFA Society Spain, who has brought us Professor Stephen Penman from the Graduate School of Business in Columbia University. He's going to talk us about something that we are reading every day about the difference between value and growth investing, and even how to discover value traps, because maybe the whole value universe is a value trap. We don't know. Okay, so I will leave it here. I will let Javier introduce our start speaker tonight. Thank you very much, Javier.
Thank you, Luis. It is with a special excitement that I'm pleased to welcome Professor Stephen Penman to this CFA webinar. Stephen Penman is the George O. May Professor in the Graduate School of Business, Columbia University, where he's also co-director of the Center for Excellence in Accounting and Security Analysis and director of the Master's Program in Accounting and Fundamental Analysis. His research deals with evaluation of equity and the role of accounting information in security analysis, and a number of his papers deal with accounting policy issues. He has published widely in finance and accounting journals and has conducted seminars on accounting and analysis for academic and professional audiences. He is also the author of two widely acclaimed books: a valuation textbook called Financial Statement Analysis and Security Valuation, which is in its 5th edition, and Accounting for Value, a book where he rigorously distills the fundamentals of value investing from an accounting perspective. And I'm not exaggerating if I say this is probably the best book on value investing written since the publication of Ben Graham's The Intelligent Investor. Today, Professor Penman is going to present a paper he co-authored and published 2 years ago in the Financial Analyst Journal. When published, the relevance of the paper was already immense, but it is fair to say that with recent developments in the equity markets, its relevance has grown even wider. The topic of the paper is how we should think about the value versus growth debate when it comes to equity investments. According to Professor Penman, traditional labels of value and growth based on price book and price earnings ratios and promoted widely by screening devices greatly distorts the economic reality of the companies. Price book and price earnings ratios are based on accounting realities, and as such, both ratios, when taken together, they convey the risk and the expected return for that risk of a particular investment. In isolation, a relatively low price earnings stock, a so-called value stock, could be considered as one with low growth expectations, or could be one with high and risky growth expectations. By adding the price book ratio, one can understand that risk, because earnings together with book value yield the book rate of return, which indicates not only expected growth, but also the risk in buying that growth due to how the accounting is done. Finally, the previous analysis also addresses other well-known feature of small cap stocks. Why buying price book predicts returns for small companies, but not for large ones. And why for large companies, the price earnings ratio dominates price book in predicting returns. We will host a Q&A session at the end of the presentation, so please leave your questions written in the chat. I will select some of them and Professor Penman will try to handle as many as he can. And without further ado, I turn over the floor to Professor Penman. Thank you.
Thank you very much, Javier, for that greeting and for the extensive introduction to the presentation. I'm not sure you left me much to talk about, but I will indeed try to flush it out. Welcome to everyone. Thank you for inviting me to join you this evening. The last time I gave a talk in Madrid was a number of years ago. It was at the old stock exchange in Madrid. The old trading floor with the wooden benches and so on, which was a delightful place to give a talk. Unfortunately, this is not as pleasant working on Zoom, a necessity in these times, but despite that, it's very good to join you this evening. As Javier said, I'm very much involved in value investing. Both in academic research and in practice. I should say the way I think about value investing is much broader than the value versus growth investing that we're going to be talking about at the moment. In fact, that is really part of the point of the presentation here, to indicate that this very simple way of investing is actually far too simple. It can lead you into a trap, and it's that trap that we want to explain. The Morningstar style blocks, of course, highlights it's a very common investment style, value versus growth investing. The Morningstar style box highlights it along with market cap, the size of firms. I think you agree these categories are not very informative. What's behind large versus small firms? What's more pertinently, what's behind value versus growth? That's what we want to talk about today. Okay, so the growth versus value investing we're going to talk about is a simple strategy of buying high earnings to price and high book to price firms, or if you wish, low price earnings and low price to book firms, as Javier indicated earlier. Value investors like to buy those earnings to price and book to price low, and growth is referred to as buying those where it's high, or the PE ratio, or price to book ratios are high. The impetus for the investing, I think, has come from a documentation that over many years, this has been a somewhat successful strategy. That tends to be that value outperforms growth. I think one of the reasons we're here at the moment is because in the last 10 years, that is turned back on us. And that, of course, is the value trap. So in these very hazy terms, the idea here is to talk about what's behind this strategy, and what is the risk that you are taking on when you actually get into this strategy. As I say, it's a very simple strategy. I think if you're in 5th grade and you can look up a book value and earnings and a price, and you know division, you can pretty well do it. Seems to me it's a bit too simple to be charging 1.75% on the AUM. Okay, so just to look at the returns. These are returns up to 2015. I'll refer to subsequent returns for all US stocks. Now, what I've done here is I've ranked stocks with positive earnings from high to low on their earnings price ratios, and form them into portfolios. Portfolios 2, 3, 4, and 5, the high ones. The negatives, firms with negative earnings are in the negative portfolio. You'll see that the strategy executed every year on all US stocks has been successful. The spread, these are annual returns. The spread between the high and the low is 8.5% per year, which is, of course, nominally with zero net investment. Long high and short low before transactions costs. Book to price is also referred to as value investing, also maybe primarily book to price. So what I've done here on this table is for those earnings to price portfolios, which you can see across the top row there. I hope you can see my cursor on your screens. I've formed those earnings to price portfolios. Then within each of those, I've ranked the firms on book to price. So what we do, we're trolling stocks on earnings to price and book to price. And you can see that, yes, there's a positive relation between the returns you would have got during this time on earnings to price, but for given earnings to price, you go down the columns, you'll see that the returns are enhanced if you also buy book to price. The differences between the highs and the lows are there with the t-statistic to indicate the statistical significance of these returns, given the variation over years. Now, if you look at it, from the low corner, 1.9% per year, to the high, 27.1%, that's a heck of a spread. It's a heck of a spread. It's a very simple strategy. A 5th grader can implement it. What's going on here? Here's what explains it. is this just gravy that it's so easy to get? One would think not. And of course, we understand that that's been so in the last several years. So here's 2015. The S&P 500 was down, was only 1.38% that year, a low return. And you see the strategy here, at least for the earnings to price portfolios 3 to 5, going down book to price, it actually went against you. Negative returns. The lower ones, there are some positive returns. Here's the bad year, 2008, minus 37% on the S&P 500. Well, you can see how that strategy's turned against you here. You've taken a hit. The difference in the returns are all negative going down those columns on the book to price. More generally, here is the MSCI value versus growth indexes for the US from 2003 up to the current year. And in the early period, you'll see the value index, which is the orange line, typically outperform the growth index. But that's turned against you in the last several years. And investors in this strategy have bemoaned the turn here. I just read yesterday in the Financial Times that a hedge fund that at one time had $30 billion US under manager has just closed on the basis because of the lack of success of their value strategy in the last 10 years or so. Okay, we want to get to the bottom of this. What's the reason for the value dominates growth in terms of returns? And what may be the reason why, in fact, it can turn against you, so you're caught in a value trap? And what could be the indicators? If you really did your homework, what would be the indicators of whether you're exposed to a value trap? That's, of course, what you want as an investor. You want to understand to what extent am I exposed to a value trap and what information will give me that. So here are some standard explanations that I've garnered from discussions and from the press about the failure of value strategies. Value stocks are in sectors sensitive to low growth economic conditions. Well, it's certainly been the case in the last several years. We've had low growth economic conditions and value has gone against us. Low bond yields force investors into fast growing tech stocks. Maybe. Book value does not include intangible assets. Return to value improve when these are recognized. The problem is the measurement of book value. A bull market, the reason what's gone against us is that we've just had a bull market in a few mega cap stocks, which have dominated, namely the technology stocks in the US. A more rational explanation is the value premium is a reward for risk, and that risk is not being realized. It's going against you. You're being hit by that risk. And of course, the other explanation is, hey, these returns are in fact gravy. The market is inefficient. You can chase glamour stocks. Value stocks are growth stocks are sometimes referred to as glamour stocks. You can chase them and you make abnormal returns. Well, maybe. I'm not going to say whether in fact there's market inefficiencies and there's actually rewards to investing in these stocks. But I'm just going to indicate that in doing so, you've got to realize that you're taking on risk and those strategies can go against you. Okay, so I'm a fundamentalist. I believe the way you invest is to first understand the business and all the details of the business, and then to understand the accounting which is representing the business and the extent to which that accounting is giving a representation of the business, what it's telling you and what it's not telling you. And that's really in the spirit of which this presentation is given today. So a fundamentalist says, look, when you invest, understand the fundamentals. A fundamental investor, of course, is a value investor, otherwise sometimes called a value investor. And a value investor really is something far wider than this simple strategy. That value investor, under a broad definition of the strategy, understands the fundamentals, which we want to do today. Two aspects of the fundamentalist view is, two doctrines, if you wish, that we follow is, first of all, ignore information at your peril. You've got to find the appropriate information and exploit that information. Using one or two bits of information, just an earnings number or a book value number, is in fact highly dangerous. It's too little information. You find yourself in these strategies. If you do that, you may be trading against someone who's actually done their homework, who's actually brought in more information, and you're going to get caught. The other aspect of that's going to come of the fundamentalist view that's going to come in here is the idea that you've got to be careful about paying for growth, because growth is risky. The fundamentalists will say, listen, you buy growth, a firm with a lot of growth in it, you got to worry because growth can be competed away and you end up not realizing the growth that you're buying. We're going to emphasize that point as we proceed here. But in doing so, we're going to indicate the extent to which the accounting for earnings and book value actually leads you into an expression of growth and the riskiness of that growth. Okay. So let's get back to our two pricing ratios here, earnings to price and book to price. Now, the first thing to understand is that given price, these are accounting phenomena. They're determined by how the accountant accounts for earnings and book value. And so a key issue to understand, is there something about the accounting for earnings and book value which have to do with conveying risk to these strategies? The earnings to price. Consider a bond. Now, in accounting for a bond, we use a method called the effective interest method. That says we calculate the interest expense on the basis of the effective interest, irrespective of the coupon. So, for example, it doesn't matter if it's a bond where the coupon equals the effective interest rate, or it's a zero coupon bond. We actually, for the same risky level of risk, we actually record the same interest. That's accrual accounting, and it says the coupon doesn't matter. It's the effective interest, and we call that effective interest as the interest on the bond. And so therefore, the earnings to price ratio for a bond is the expected return for the bond. It's the bond yield. We book that interest at the bond yield, the yield on the bond, and the earnings to price ratio for a bond is always the expected return for risk. So in that case, EP is picking up risk 1-to-1 because it's picking up the bond yield, and bond yields are related to the riskiness of the bond. Could this be the case for a stock? Well, bonds and stock differ because a bond can have no growth, but a stock does. And of course, the EP or the PE ratio incorporates that growth. Typically, we think a higher PE ratio or a higher EP ratio is one that indicates that the firm can give you some growth, earnings growth. But one thing to remember here, and this is a point to be emphasized, the growth could also be risky. So when you're buying growth, you may be buying risky growth. Beware of buying growth because growth is risky. Now, the book to price. Let's think about the accounting for book value in a book to price. And let's think about two investment funds. One is a risk-free money market fund in US government securities. They've never defaulted, They're considered risk-free. I must say we're getting worried about that. What's the book to price for the bond? Well, it's always 1. Why? Because the bonds are always marked to market. Think of a risky equity fund where you trade into the fund at NAV and you redeem out of the fund at net asset value. What's the book to price? It's also 1. Why? Because in both of these assets, we use what's referred to as mark-to-market accounting, or more broadly, fair value accounting. So in that case, book to price cannot indicate risk. The accounting takes away the ability for book to price to indicate risk. However, for anything other than an investment fund, industrial companies, retail companies, and almost everything else, besides some financials, we don't use mark-to-market accounting. We use what's referred to as historical cost accounting. And historical cost accounting typically presents book values on the balance sheet below price, and the price to book ratio is greater than 1. We use a different type of accounting. So we ask, is there anything about that accounting which will indicate that when we buy book to price, we're actually taking on risk? Okay, let's think first about these two separately. Let's think first about the PE ratio. Here now is a very simple valuation model, okay? It's only strictly true if you have full payout, and of course only with positive earnings, but I can put up a much more complicated expression for the PE ratio, but it won't give you any more insights. So price is just forward earnings, earnings 1 period ahead, are capitalized at the required return R for the risk minus the growth rate. And so the earnings to price is just R minus G. So we typically think of the PE ratio, with the PE ratio, the growth, having a negative sign here, increases the PE ratio or decreases the earnings to price ratio. That is, you get more growth, you get more price. And so therefore, you have a higher PE ratio. But we've got to be careful. What if that G, which I'm highlighting here now, is risky, such that you require a higher return? If there's growth involved, and actually it's future earnings, you haven't got the customers yet, you haven't got the revenues, you haven't got the earnings, it's still at risk. Well, if you have higher growth, then you've got to have a higher R. In one particular case, maybe if you increase the growth, you increase the R, and the R minus G does not change. The point here is, of course, is that an earnings to price ratio or a PE ratio does not just pick up growth, it picks up risk. And so if you look at a given earnings to price or PE ratio, you've got to ask, hey, is this a firm with a high risk and high required return R and a high G, or one with a low required return and a low G? I've got to understand that, because otherwise I might fall into a trap. Here's of last Friday, Citigroup, the forward PE 7.5, low, EP of 13.4%. How do I read that? Is this a stock with low growth prospects or a stock with very high growth prospects that's risky? And I'm taking on risk. If I buy this low PE ratio or this high EP ratio of 13.4%, is this one that's going to really do well for me, or is it one that actually there's a lot of risk here that I've got to be concerned with? Apple. Now, of course, it's done very well. The PE is over 30%. It's over 30. The earnings to price is 3.3%. Is this firm with a high growth prospects with very low risk? Or in fact, is it firm with prospects that are not very risky? Now, to get us going here, I want to refer back to, I hope you know, the PEG ratio. It has been a very popular screen for selecting stocks. It's actually an improvement over the PE ratio because what it says is how you calculate the PEG ratio, which stands for price earnings growth, PEG, is that you divide the forward PE ratio by an estimate of the future growth rate. For Citi, that's 7.5 for the PE, and the analyst's forecast of growth is 4.6%, so it's 1.63. For Apple, it's 2.4. Now, the standard interpretation says, if in fact you have a low PEG ratio, that's a buy, because you're getting high growth in the denominator, but the market's pricing that growth at a low forward PE multiple. It's a buy. That would tell you buy Citi rather than Apple, I guess. But there's a fallacy here, very well to note, because the PE ratio does not just reflect growth, it also reflects risk. And if the risk of the growth is higher, then the PE ratio will be lower, because the market discounts price for given growth for the risk. And so buying a low PE ratio or a high EP ratio, like Citi's 13.3% EP ratio, you may be just taking on risk. It's a low PE or a high EP, but it's a very risky prospect. This has to be sorted out. Just to confirm this more generally, here is a ratio between PEG ratios and betas. Now, I won't maintain that betas is a sufficient measure of risk, but you'll see as I form stocks into portfolios from 1 to 10 along the horizontal axis on beta, which is the dotted line going up, as the betas increase, the pegs go down. That is, if you have higher beta, you're going to have a lower peg, which means, of course, that in that case, the growth is being discounted more for the risk that's in the beta. Okay, so I just want to get that across first of all. Hey, always, PE ratio always involves risk and growth. Now we're going to add the book to price to the earnings to price. And now I'll go back to my panel I had earlier, and you can see these quite impressive returns going across the diagonal there for this 50-year period. So what's happening now is we introduce book to price. Well, here's a very simple bit of math. Maybe not 5th grade, but 6th grade, 7th grade. The book to price is always the book value over the forward earnings times the earnings over the price. And so I guess that is the 5th grader will tell you the earnings cancel here, but we have two components here. We have the inverse of the book rate of return, earnings over book value, and we have the earnings to price. And so the book to value is always 1 over the return on equity multiplied by the earnings to price, which of course I've characterized in my valuation model as R minus G, that is determined both by risk and by growth. Okay, so now we have 3 statements. And these are 3 statements that we're going to take to the data. First, if you want to rank stocks on book to price to go high, low, value versus growth, a ranking on book to price is an inverse ranking on ROE, holding the earnings to price constant. Now, again, in this panel here, what we're doing here is we're holding earnings to price constant, let's say in portfolio 2, and then ranking on book to price to give ourselves a higher return. But that ranking on EP is an inverse ranking on ROE. Now, we don't have to demonstrate that because that's just a mathematical property, always true. You know, a fundamentalist always latches onto things that are always true. There's so much uncertainty in investing, to understand things that always have to hold is very, very important. Okay, so the second point is a higher BP must be associated with a higher growth if a lower ROE is associated with higher G. holding earnings to price constant. Thirdly, a higher book to price must indicate a higher risk and required return if a higher G is associated with higher risk. That is, if G goes up, it's risky, and so you require a higher return. Okay? As I said, the first statement is always true, but the last two have a conditional if. Okay? And so we have to understand whether, in fact, ROE is associated with a lower ROE is associated with higher growth. Now you think, the firm has a low ROE. Does that mean it's going to have a higher earnings growth? How does that work? Okay, well, let's go and look at it. Now, what I've done here to just demonstrate point one, even though it's just a mathematical property, is I've said, look for those same earnings to price portfolios and book to price. I report to you the ROEs, and you see now, as you go down the columns for book to price, the ROEs decrease. These ones, high book to price, are actually low ROEs, and low book to price are actually high ROEs, return on equity. Okay, I didn't have to demonstrate that. That's always the case. Now, the second point, of course, has that conditional if statement there. And so what I've plotted here is for these same portfolios, I've replotted the growth in earnings that the portfolio gave you 2 years hence, after the forward year. I can show you 3 years hence, I can show you 4 years hence, and you get the same thing. And you'll see, of course, that across the earnings to price, growth is decreasing in earnings to price, or it's increasing in price to earnings. That's the standard notion that PEs indicate growth. As you go down the columns, however, you'll see that low book to price, which remember is low book to price, which is high ROE, return on equity, is associated with a lot lower growth than the firms with low ROEs. In column 2 there, oops, excuse me. In column 2 there, 7.1% versus 29.1% for the firms in that with the low ROEs. So there we have a validation empirically that lower, for given earnings to price, lower ROEs deliver you more growth on average. However, the third point is going to be very important, because is it the case that growth is risky? And if the growth is risky, we're going to pay less for it. And we're going to have a lower price and therefore a higher BP. Well, here I give you the standard deviation of the growth rates 2 years ahead for the portfolios. And you can see again that as you go down these columns here, you go the standard deviations increases. You have much more variation in outcomes, earnings growth outcomes, down with the high book to price or the low ROEs than you do with the high book to price, the low book to price or high ROEs. And this actually is correlated with the returns. Excuse me. Now, the way I think of investing is, hey, the question of how well you're going to perform in the tails. That is when things get really bad or things do very well. So what we do here is for these same portfolios, I give you the interdecile range. That is the 0.9 percentile minus the 0.1 percentile of the realized growth rates. And you can see quite dramatically, actually, as you go down these columns, that interdecile range increases as you get to the high book to price or as you get to the low ROEs. That is, if you buy these high book to price firms, you're going to have much more high probability of doing very well, getting in the right tail of the distribution, but that's going to be balanced by the fact that you're going to have much more likely also to get in the extreme left tails. You're going to lose your shirt. Okay. I'm going to move on pretty quickly because I see our time is going and I want to leave time for questions. But what I've got here is earnings betas. These are just like return betas, but they're betas in earnings for the portfolios. These, you see, are increasing as you go down the columns. The upmarket beta is increasing, but the downmarket betas are also increasing. That is, in upmarkets, you do very well in these risky earnings, risky growth portfolios, high book to price, but you do very badly in down markets. Okay, so now we have a little bit of what's going to happen to you, a description of what's going to happen to you as you get into these portfolios, for which I have repeated here, the return spread you've got. So it's very clear that the return, that in the lows down here, the growth and the risk to the growth is much lower than those down here. So we can see that, in fact, these differences in return, this spread is really has fundamentals behind it. You are exposing yourself to more risky growth as you go down the columns here, okay? But also as you go across on the EP ratios here, and the combination of a high EP and a high book to price yields, on average, it yields your higher returns, but it is subject to risk to the growth. That's what happens to you, and that really is the value trap. Okay, so that's an explanation of the risk behind the returns in terms of outcomes, earnings outcomes. However, I want to take a little bit deeper. I study value investing, I work with value investing, but at heart, I am just a dumb, dull accountant, okay? And I found this huge benefit. However, I found this huge benefit from understanding the accounting and understand the accounting for earnings and book value. Okay, so we have an accounting principle here. When I was a boy, which is a long time ago, my first accounting class, the professor said to me, he came into the class, he said to the class, hey, listen, when you keep your accounts for your tennis club, you use accounting called a cash accounting. And all you do is have a cash account on the balance sheet, and you have cash flows in and cash flows out as the flow numbers, in a cash flow statement. However, in business accounting, we use a different accounting, and it's called accrual accounting, where we recognize earnings are different from the cash flows. Over the life of the business, the total cash flows are always equal to the total earnings, but in any individual period, we'll recognize a different number for earnings that's all different from the cash flow. And of course, you'll see that in comparing the cash flow statement to the income statement. Then he says, and this has stuck with me, what is the primary driving principle of accrual accounting? Well, here it is. Under uncertainty, the recognition of it, we don't recognize earnings until we get uncertainty resolved. That is, we defer, even though you anticipate earnings, you don't recognize them in the accounts until you get the resolution of uncertainty. That, of course, is called the revenue recognition principle. You have to get a customer with a legal claim on that customer. You can take them to court, and even then the receipt of cash has to be reasonably certain, or in the new IFRS standard, it has to be highly certain before you can recognize the revenues. You see how risk is involved here. We don't book earnings until we get the resolution of uncertainty. That, keep in mind, is the driving principle for accrual accounting. And accrual accounting, a way to approach the accounting when you analyze accounting is to see this. Accounting is all about tracking risk and the resolution of risk. Now, there's another aspect of the accounting. When we make investments in inventory that we can sell tomorrow, probably, we put on the balance sheet. When we make an investment in property, plant and equipment, fixed assets that produces that inventory, we put on the balance sheet. However, when in fact we make investments where there's uncertainty about the outcomes, we don't book them to the balance sheet. we charge them expense into the income statement. R&D, or an IFRS, research, development goes on the balance sheet. Advertising, promotion, building brand, startup cost, investments, employee training, customer development, customer loyalty programs, supply chain development, and a whole lot of other, these so-called intangible assets are booked to the balance sheet. Why? Well, if you go back to your accounting standards, for example, IAS 38 under IFRS, it says it's because the future payoffs are uncertain. You can only book it to the balance sheet if, in fact, the payoffs are probable. Even IAS 16 under IFRS says you don't book property, plant, and equipment unless there's the payoffs, the earnings are probable. So that's another principle that doesn't affect revenues as the first one, but affects expenses. What does this do? Well, what this does, of course, it gives you lower earnings. If you charge that investment to the income statement, it gives you lower earnings. And earnings are the numerator of ROE. It's called conservative accounting. I'm not going to let you put research into a drug where you don't have a product yet, and you may not have a product, and put it on the balance sheet as if you've got collateral like plant or inventory. That's what the accounting says. That reduces the ROE, the numerator of the ROE. You see what's going on here now. A low ROE is one where the accountant deems there is risk of the investment and has depressed the ROE to give you a low ROE. That increases expected earnings growth, however, doesn't it? Because that investment is made with the expectation you're going to get earnings. If you get the earnings, you're going to have high earnings, not only because you get the earnings, but now you'll have no amortization or depreciation against those earnings because they've been written off. And so the accounting involves in the accounting, that gives you expected growth, but actually it's risky growth because we've deemed it to be so. However, if in fact you get the earnings from this risk investment, then you're going to have a very high ROE, aren't you? You get the risk resolved, you're going to have a high ROE. And why? Because you're going to have those earnings in the numerator, but the investment that you made is not on the balance sheet. It's not in the book value. So you got high earnings relative to a very low book value. So a company like Apple actually has almost zero book value in its business. The only book value comes from the large amount of cash it has because it's expensed all the investments that have generated that earnings. So you see now there's accounting reasons why, in fact, you get growth, and there's accounting reasons that tells you that, in fact, a low ROE is going to be associated with risk and a high ROE with lower risk. And that's what we see in the returns, and that's what we see in the variation, the riskiness of the outcomes that I have documented. I've got a few examples here. I see my time's running out here, so I'm going to leave these examples to you. I've told Javier that this presentation can be available for everyone, for you to go back and go through more thoroughly if you wish. The first one here is just Twitter. Twitter reports losses. I think it's only 1 quarter it's ever reported a profit. Why? Well, it's got revenues coming in. But if you go and look at its income statement, last time I looked, 80% of the expenses are R&D, advertising, and promotion to get future revenues. It's being depressed by these revenues. So it has a very low ROE. The trailing ROE at the moment is 15.4%, negative. Now, if in fact it pays off, all these investments pay off, it will have a very high ROE. Facebook, very similar. Amazon, very similar. Every year, the guys investing in something new. If it's not video streaming, if it's not grocery delivery, if it's not technology content, if it's not drones to deliver your toothpaste through your bedroom window, he's investing. And if you go to the income statement, there's a line there called technology platform development, which is billions and billions of dollars being charged against the earnings. It's making profits, ROE, 15.8%, but it's not particularly high. There's other examples. Okay, so I'm going to close here. So leave time for your questions. But I hope you've got the message here. In these returns, so earnings to price and book to price, when you get into these portfolios, you're buying growth, different growth. Where you're buying growth which is risky. And if you have more risk, you should on average earn a higher return. Explaining the higher returns down here on this bottom row here and down in this quadrant, in this southeast quadrant here, okay? You're buying risky growth. We've documented that in terms of actual historical data, but we've also documented that to show that actually this is induced and indicated to you by the accounting. Beware of buying a low ROE firm with high potential growth, because that growth is risky, as the accounting communicates. Never make a mistake that a high ROE or a high return on asset, a low ROE or low return on asset firm is unprofitable. No, look at the income statement. See what investments being charged against earnings. This is probably a firm which is not profitable now, but potentially is very profitable if, in fact, the risky investment pays off and the implied risky growth is actually realized. That, by the way, gives you a very different interpretation of return on investment when the accounting is involved. Okay, so I'm going to finish up. Sorry to take a little bit of your question time here. You'll notice one thing here. This whole value versus growth nomenclature labeling is suspect. We're just seeing that high book to price, which are called value, is actually the ones that give you risky growth. There's a necessity here. We got to really think our labels. Value versus growth is a very, very misleading labeling of what you're getting hold of. High book to price is the ones that are giving you the risky growth, okay? Not the low book to price, in conjunction with the earnings to price. So I close with a famous statement from a person who needs no introduction. Most analysts feel they must choose between two approaches customarily thought of being in opposition, value and growth. That's fuzzy thinking. Growth is always a component of value, and the very term value investing is redundant. And what he's saying here is, hey, you can really buy value if you do your homework and you can buy growth, but you've got to evaluate the growth and the riskiness of the growth in making that. You can value investing and also involves buying growth, but you'll have to evaluate the growth and the riskiness of the growth. So there we go. I thank you for your attention. I'm sorry to leave you about 10 minutes of question. There is some source reading if you want to continue further. So I'll pass it back to the chair, Javier. Thank you very much.
Thank you very much, Stephen. I think it has been a brilliant and very thoughtful presentation. We have some questions. The first one is, I mean, the accounting was done in lever terms, price earnings, price book, right? How would the results change if we had considered unlevered metrics such as enterprise value, net operating assets, or enterprise value, net operating income, which are metrics that you usually use in other books, and that you always say is that leverage shouldn't matter for valuation?
That's a very good question. Thank you. Yes, one of the first thing in valuation is to distinguish the enterprise from the financing of the enterprise. Okay, that is, and what we're interested in particularly here is enterprise value, or enterprise price to book, and enterprise price to earnings. I've couched it in these terms because for the publication of the paper, that's how people typically think about it in terms of the levered number. But the questioner is quite right. You want to distinguish, because actually the conservative accounting that I'm talking about operates in the enterprise book to price, okay, and the enterprise earnings to price. It's the earnings from the enterprise and the earnings for the book value for the enterprise. So that's what happens. It turns out that you've also got to think of leverage when you buy the firm, as always, because leverage is dangerous. And there's a subtle point here, which is also a trap, which I haven't referred to. How does leverage affect a PE ratio? Let's suppose I have a PE ratio of 15 on an enterprise basis. Then I add leverage. What happens to the levered PE ratio? It goes down. Depending on the leverage, you can drop to 12, 10. So the PE is lower, and you think, oh, this is a lower price stock. But what you're doing is you're buying leverage, as well as possibly buying this growth risk. That is missing from the paper. So it's a very, very perceptive question, okay? There's a leverage aspect always. I just want to point out, these accounting effects are on the enterprise amounts, okay? Leverage adds further risk, and leverage actually decreases the PE ratio, but increases the price to book ratio. That's another story for another day.
Another question says, why is earnings generated by investments in R&D, marketing, brand building, and the like considered riskier according to GAAP and IFRS accounting rules than investments in PPE and inventory? At the end of the day, isn't risk idiosyncratic and much more dependent on the particular firm? And then he says an example, why should a firm like Alcoa or US still be considered less risky from an accounting point of view than Gilead or Google? I would argue that the first two firms are far riskier from an operational point of view than the latter.
Quite right. In some sense, this is as we do as when we write papers, we're holding other things constant. There are other aspects of risk also, of course. And of course, tangible assets on the balance sheet have risk. And that risk has also got to be recognized. However, it's a differentiation here. Typically, on average, not necessarily for all firms, the investments booked to the income statement are deemed to be more risky. So, for example, consider a startup biotech with no investing heavily in R&D. There's no product yet, let alone customers and revenues, and there may not be a product. That is probably more risky, and it's going to have a low or negative ROE. That company is probably more risky than a mature pharmaceutical, which has successful R&D, which is coming through the income statement. They've invested in R&D in past, but the R&D has been successful, and that's coming through the income statement. The accounting standards say it's based on the probability of the uncertainty of the future benefits. Even with property, plant, and equipment and inventory, they say you've got to establish that it's probable that you're going to get the benefits. With a startup R&D, that probability is lower. So it's a matter of degree. And keep in mind also, the standards also say that even if you book inventory and plant to the balance sheet, if in fact there's a revision in the probabilities of the outcome, you've got to write them down, you've got to impair them. And that is just a further application of the conservative accounting.
Okay, thank you very much. We have 3 more questions, Steve, just to keep track. Yes, another one is similar to the previous one in the sense that it says risk is more than can be measured by what you spend or invest in a business. How about looking at industry dynamics, competitive pressures, pricing power, or lack of it?
Yeah, well, by the way, just to finish up on the last question, what we're looking at here is averages. And this is sort of what's going on average in the firm. There may be some firms which are doing R&D, which actually is less risky. So, and the accounting is not working perfectly. There's nothing to say the accounting, there's nothing here to demand that the accounting is working perfectly for every firm. And indeed, as you probably know, in the US, we expense all R&D, research and development, whereas under IFRS, they say no. Once you've got to the stage of actually having successful R&D, you can capitalize the development component. Okay. Oh, sorry, Harvey, I lost track of that question. Say it again.
Yes, it said that risk is more that can be measured by what you spend or invest in a business. How about looking at industry dynamics, competitive pressures, pricing power, or lack of it?
Oh, most certainly here, most certainly here. Listen, as I said earlier, you're doing fundamental analysis. There's two aspects. The first thing is understanding the business. And one of those big things is there growth here? Can you get more customers, make more earnings from the customers? And is it possible that can be easily competed away? Okay. Yes, you can get into cloud services, and the initial Amazon initial ones had a competitive advantage for a little while, but very soon the IBMs and everyone else came in, the Dells to compete against that. Let me say very definitely here, the first thing in fundamental analysis is understanding the business. The accounting is secondary. I'm dealing with actually the lesser aspect here, the accounting aspect, how you read the accounting, okay? I remember Warren Buffett saying once when he came to Columbia, he's a graduate of Columbia, the thing I do is I understand the business. And then what I do is I pull down the 10K, the annual report, pour myself a cup of coffee, and I eat that annual report for breakfast. I've got both, but the first thing is the business. And so the question is right on cue.
Okay, a couple more questions. A large part of the results of the paper are due to the information conveyed by historical cost accounting and by the principle of prudence. Given that over the last few decades, mark-to-market accounting has been gaining ground and that the principle of prudence has been questioned, how would that change the results of the analysis?
Well, I'm as an analyst, I'm very much very doubtful about fair value accounting. For some cases where you're simply holding an instrument or a security where your payoff is just directly one-to-one fluctuation with the market price, it's okay. But in principle, what fair value accounting does is takes away the ability to indicate the risk as we have just done in this presentation. What it does is says, I'm not going to wait until realizing the earnings until risk is resolved. I'm going to take all the present value of the future earnings or the cash flow, discount them back at some discount rate, and put them in the balance sheet and call it fair value. Best of luck with the discount rate because you've lost information about the risk. And so what you have is a balance sheet, which is shockingly, in my mind, risky. That's the banks in 2008. You start fair valuing mortgage packages to fair value, put them in your balance sheet. We don't understand the risk. Even the raters, bond raters didn't understand the risk. And suddenly you wake up in the morning and the thing's been hit. You've been hit, but you couldn't understand the risk. So from this point of view, I'm very much apprehensive about fair value accounting. And you know, there's a historical reason for that. In the 1920s, in the boom times, firms used a lot of what we call today fair value accounting, writing up assets. And of course, in October 1929, all that value evaporated. And actually, it was that experience that actually was the birth of the fundamentalist movement with Benjamin Graham, who said, you accountants, no more water in the balance sheet, okay? Don't book the earnings until you get a customer, till you get resolution of uncertainty. Don't guess at the fair values of what the customers are going to bring you in the future. No more water in the balance sheet. And that has been the doctrine in most of our accounting, formal accounting, through until the mid-90s. And regretfully, I think there's actually been an advance of more fair value accounting. Now, as I say, in some financial institutions, it's appropriate with respect to some instruments, particularly derivative instruments. But I don't like it. I lose information as an investor. Indeed, actually, the Financial Accounting Standards Board and the International Accounting Standards Board in London have backed off very much from fair value accounting. You're not going to see more of it. You're going to see less of it, I think, or at least no more of it.
Okay, that was very detailed. And then we have a final question. It's a bit off mark. It seems that it's from one of your readers here in Spain about your books. It says, in the valuation process, return on net operating assets and net book value act as checks and balances. Sometimes M&A distort the picture of the business. What would be the best approach to valuation in this context? Thanks.
The question is the best evaluation when you've had an acquisition?
Exactly.
Okay. Well, what you've got to be concerned, of course, actually under the accountings is it now, the purchase price of that acquisition comes onto the balance sheet. You'll notice that in doing so, you've got a much higher balance sheet. A good deal of it is in goodwill, driven by the purchase price. So you're going to be concerned about whether firms have overpaid for the goodwill. One thing you'll notice, first of all, that the book rate of return comes down. But even though you get higher earnings, you're going to have higher book value. And it's always the case that the firm with an acquisition looks less profitable than before the acquisition, sometimes dramatically so, because a lot of value has come onto the balance sheet. So that's something you have to be careful of. The other thing, of course, is that to keep in mind is once you've got that on the balance sheet, it should stay on the balance sheet. There's some tendency of analysts to strip out goodwill, particularly in banks and financial institutions. That's not right. You've paid for that asset, just like you've paid for inventory, just like you pay for plant. You have got to cover your cost of capital. And so therefore, to calculate the value added or the residual income, you've got to keep that on the balance sheet. And if you've overpaid, you're going to have negative residual income or value added income.
Okay, thank you very much. I think this was it, Stephen. Well, thank you very much for the presentation on this very topical issue. And maybe Luis wants to conclude with a few words.
Thank you very much, Javier. Nothing else. Thank you, everybody, for being here with us tonight. Thank you, Stephen, for this bright presentation. And that's it. Thank you for CFA Society Portugal for being with us tonight also. Have a nice night.
I said, evening, everybody.
Thank you, Stephen. Bye.
Bye.